like, okay, they're gonna pay me 7.5% just for owning, and then the stock price gonna go up 100%. So it's like, bruh, however long it take to double up, they're gonna pay me 7.5%. That's more than a high yield savings account. Then I wanted to go over as well with y'all some fundamental ratios just to help y'all benefit from, profiting off of good companies. Like, how do you know it's a good company behind the scenes, really? Like, how you know they handling their finances right? See, all this shit is gonna be positive soon. And see, this the other thing too. When you read the news and like listen to their earnings reports, you will understand, like, okay, you'll understand like what the CEO really doing and what the leadership team really doing to like change the game for their company and for their stock, So if you see something like this, like even for IT, all right, what's good, man? Today what we're finna go over is like 5 stocks that I know gonna bounce. You feel me? And y'all gonna know they gonna bounce too after this. What we're gonna go over is some technical analysis. I'm gonna flip through them real quick. And all these companies that you're gonna see on here, they're gonna be good, major, well-known companies that essentially won't fail because they're globally known, and they're globally efficiently and profitable and productive. And I guess we can start the list off with UPS. Like, okay, boom, why do we think UPS gonna bounce at this $86 level? Well, if we zoom all the way out, this resistance support was like first made back in 2004. The 2004 resistance, boom, met here a little. Let's do a little drawing, little drawings, boom, little drawing. All right, and now it's here again. So as we can tell, like the last one, two, three, four, five, like the last 5 times previously it got to this level, it reacted. It reacted positively, and it's gonna react positively again. Why is it gonna react positively again? Well, let's add this to it. This RSI right here. Every time it gets to the bottom of this RSI on a monthly time frame, we see what happens. We see it takes off. The last time it was here, it was what, $37.99 when it was at its lowest RSI. I can't even draw. And then it went up to look 233. But let's also go over a little more things in detail that would cause questions or that may come up as a little risky, you feel me? Because it's a risk to every investment, in real estate, stock market, and gold, and cars, and jewelry, risk everywhere. So we gotta understand the risk before we make the investment. Okay, so if we analyze UPS, I ain't gonna lie, I'm already in UPS. I started getting UPS at 100, but then it dipped down to 88. I got in some more. This is what I always do. I go in levels. This is what the pros always do. We always size into positions and levels. Well, I ain't gonna go into that deep. I'm gonna just give y'all the top 5, cause then it's already 3 minutes. If I talk about this stock for 5 minutes, then I ain't gonna get to the rest. All right, UPS. Then the next we got IT Garner. Why do I think IT Garner is gonna do great? Well, first off, they did great on their earnings report. Boom, they beat their earnings report. Their revenue is increasing annually. You feel me? They have a healthy balance sheet. Their operating cash flow is increasing annually as well. Let's see. Oh yeah, they're also profitable. They're also on that big dip, on that big sale. We're gonna zoom in on the daily time frame. Another thing is, every analyst gonna expect any stock, any good company you looking at that's on a good dip, that's profitable, that's great. every analyst gonna expect them to do better in the future. That's gonna be everywhere you check it out. So you want to see, you just want to see that. Don't buy just because you see this, but just because you see that, that's a plus. Okay, then we also, this a little thing I wanted to go over as well with y'all, some fundamental ratios, just to help y'all benefit from, profiting off of good companies. Like, how do you know it's a good company behind the scenes, really? Like, how you know they handling their finances right? So all this information is accessible to us now. It's easy to get, man. Just do the same thing I'm doing, type in the same thing on the browser, man. And but first thing we're gonna do is go over 7 definitions real quick. Operating margin: profit a company makes on a dollar of sales after paying for variable cost of production such as wages and raw materials, but before paying interest or tax. 20% plus is great. So we was just talking about IT, right? IT Garner. Look, let's see what their operating margin is. It's anything above 15% is good. Their operating margin is 17%. So after they pay their employees, after they pay what they need to pay for their products, they're making a good profit. That's good. That's what you want to see. That's how you know, okay, they're bringing in money profitably. Okay. A lot of companies, you will see this. You will see this in the negative. Why would you invest in something that's, you can invest in something with a negative operating margin if you know they finna be bringing in billions next year. Like check this out. One play on my Roth IRA, they finna be profitable. They gonna be profitable. They damn near right there. Of course they gonna be profitable. APLD is gonna be profitable, but they all have a negative operating margin right now, which doesn't mean they're a bad investment. But cause I'm up on I'm up on here. Wait, down for sure. Up on here, and they operating margin negative. But once the operating margin do go above 20%, I'm for damn sure gonna be up, man. Okay, operating margin is good. Debt to equity: because debt is inherently risky, lenders and investors tend to favor businesses with lower DE ratios. For lenders, a low ratio means a lower risk of loan default. For shareholders, it means a decreased probability of bankruptcy in the event of an economic downturn, 2.0 or less. So basically, debt to equity, you want to see it below 2.0. You don't want to see them over leveraging their debt. You feel me? Just like as consumers, we shouldn't over leverage our debt to income. Companies shouldn't over leverage their debt to equity. Let's look at IT. Debt to equity below 2.0. That's good. Let's keep going. Free cash flow growth. Free cash flow growth is the amount of cash that a company has left after accounting for spending on operations and capital asset maintenance. Let's look at IT. Their free cash flow trailing 12 months year over year is up 50%. So they have more money sitting in their bank account. They have plus 50% more money sitting in their bank account at the end of the year. Well, over the last trailing 12 months. So it's not negative. So they're having an influx of cash. They're doing the right thing. They're making more money, essentially. Their cash flow is growing. They got more cash. Return on equity is a gauge of a corporation's profitability and how efficiently it generates those profits. The higher the ROE, the better a company is at converting its equity financing into profits. 15% plus is good. So basically, how profitable are they with their equity? You feel me? Like you investing in them, you buying that one share. What is they gonna turn that into? How much profit is they gonna turn that into? Are they gonna do good things with it? Are they gonna be profitable? Is it gonna be a plus or negative? If we look at IT, look at 116%. That's phenomenal. That's the highest one on the list. I just realized that. Let's check the IRA. Let's see what that's talking about. Okay. See, all this shit is gonna be positive soon. And see, this the other thing too. When you read the news and like listen to their earnings reports, you will understand like, okay, you'll understand like what the CEO really doing. and what the leadership team really doing to like change the game for their company and for their stock, you know. So if you see something like this, like even for IT, they just reported earnings. Listen to their earnings report, like yeah, just do that and have a notebook and take hella notes. Like so, like see even me for myself, man. This my stock notebook. I got hella stock notebooks, man, everywhere. This just one of them. Notepad right there. It's just everywhere, you know. Swing position journal. You know, it's all on my phone with screenshots. I mean, you just gotta act like it can change your life, and it'll change your life, you know, and just keep holding long term. But IT is a good one. Let's keep going. We looked at all this more awesomeness, you feel me? Stuff that's not a word. Because look, even if you can say awesomeness and it's not a word, you can still be smart enough to invest, you feel me? Dividend yield, a stock's dividend yield is a ratio showing how much a company pay out in dividends each year relative to its stock price. Mature companies are most likely to pay dividends. Like UPS, look at their dividend, they're paying 7.55% a year. That's why I'm going crazy into them. They're gonna be the next one I go over on this list. I think I already went over them. You already did. That's one thing I missed out on was their dividend. They're paying $1.64 per share that you own. And that's how people get rich, essentially. Because think about this. Look, right? Okay, say over your lifespan, you accumulate $1 million. This is just hypothetically times it by 7.5%. Times it by 7.5. I'm tripping. See, you ain't even got to be the smartest person to be the greatest investor, man. I didn't even put times this time. It's crazy. It's gonna be $75,000 basically. $75,000, and you basically they gonna pay you this much for owning their stock, and their stock price gonna accumulate over time. So it's like, okay, they gonna pay me 7.5% just for owning, and then the stock price gonna go up 100%. So it's like, bruh, however long it take to double up, they gonna pay me 7.5%. That's more than a high yield savings account. That's more than the bonds. That's more than, you know what I'm saying? It ain't more than the average of the S&P 500. That 10-12%. You feel me? But this gonna potentially outperform the S&P 500 because it's gonna be paying you 7.5% per year, and then 3-4 more percent. That's all I need. That's all the share price need to move for you to outpace the S&P, and it's of course gonna move that fucking much because look how much it got to recover back to all-time highs. It's gonna. All right, but okay, what's next on the list? Market cap. Market cap is basically the total outstanding shares times the share price. Nvidia has the highest market cap as of right now to all the stocks, and I own Nvidia. And look, this how you got to do it, right? This how you always have to do it. I started buying Nvidia on the dip. This what you'll realize. You'll see stocks doing this, like how IT is doing this now. Look, IT is doing this right now. I'm gonna show y'all. IT, see how it's falling down? See how when the video was falling down, it's not doing the same pattern, but when it does fall down at these support levels, it's falling down, it's gonna take off again. And that's how you make your money. Like, that's how you can tell when the share price is undervalued, and you just buy it when it's undervalued, you know? But yeah, what's next? FI, we got FI that's next. FI on here, let's check it out, let's see. Current ratio, divide all the company current assets by its current liabilities. The current ratio helps investors understand the company ability to cover its short-term debts and bills. As again, you want to make sure they're financially stable. These ratios are fundamental ratios, help you see if they're financially stable, essentially. This is going to help you check the current ratio. Anything above 1 is good. And as you can tell, a lot of these above 1 and 0.95. Look, oh my God, it's below a 1 doesn't mean it's a bad company. No, Because it's like each ratio could be totally, I mean, all these ratios could be against you, but the share price could still be going up. But back to the list. FI is next on the list. Why is FI next on the list? Let's check it out. It's coming down here at this resistance made back in 2020. It's very reactive, you know. It reacts a lot. It finally broke above that. It's coming back down. Check this out. See this green line, this 200 EMA. Every time it gets below this 200 EMA, it bounces, right? See right here is 13% below the 200 EMA. Right here, it was 11%. Back in 2020 during COVID, it broke 7%. Okay, it been holding this EMA consistently for the past, over the past 15 years. Back in 2009, 2008 crash, damn, that's when it really, you know. So if it ain't nothing coming crazier than the 2008 financial market housing bubble crash, I was only like 7 back that time. I ain't know. I wish I started investing at 7, but I didn't. But if anything crazier like that don't come, then FI technically is gonna bounce again. Let's check this out too. And also look, it's below the 30 RSI. You already know what happened when it get below the 30 RSI. If you don't know what happened when it get below the 30 RSI, I'm about to show you. Okay, it did a little pop. That ain't shit though. That ain't the pop we want. The pop we want is something that's like 30%. Look, okay, last time it went this high, right? How much is that? 213%. So in 2000, just 5 years, if you would have invested, let's see, 213%, let's see, just say 1,000. Well, that's gonna be $3,000. I'm gonna do it anyway. I'm gonna do this shit anyways. Plus your 1,000. That's how much $1,000 would have turned into. Just letting it sit. That's why this shit better than a high yield savings account, bro. This is how you grow wealth long term. Just the RSI, weekly time frame, monthly time frame. And we finna get into more stuff. ELV is next. I'm finna end this video because it's 17 minutes long. I know y'all got some good info. And I appreciate y'all for watching this shit. If it's too long, hey, just let me know. And then path, I got a starter and path. I always enter in levels, man, cause like this shit could keep falling. Like, what if it come down here? What if it come down here? Add on the dip. Like, if you know it's a good company, just hold on to it. Buy it the best value you think you can get. Be patient, sit on your hands, and wait for it to confirm some shit. Like IT, I wouldn't get in IT yet, even though I'm already in it just a little bit, cause I know it could gap up, but at the same time, it could keep falling, and it's like, when you got a small account and shit keep falling, bro, you can't keep adding at the bottom, cause it's like you gonna run out of money fast adding at the bottom. The smaller your account is, the more patient you gotta be. Like, okay, yes, this is a good level. This is another good level. And then this could be like a last level you add. So it's like, okay, if I start entering here, and my last enter is here, it's 27%. My stop loss, 36? I can't risk no more than 36. And I can hold it back up here or more. So it's like, that's how you gotta kind of do it, you know. You can't, I mean, you could go all in here, it's all up to you. Long as whatever you plan to do, you do this shit every day and be disciplined to it. Because that's the only way you're gonna win. If you change what you do every day, you ain't gonna have a consistent strategy of winning is like the casino. Like if the casino changed their strategy every day on how they beat you at blackjack and fucking spin the ball and whatever the shit called, then if they change their strategy at beating you, they wouldn't have a consistent profitability rate. But since they fuck y'all gamblers the same way, they fucking win. That's how they fucking get that big, bro. So it's like when you enter the market, you gotta come the same way, the same sight picture, the same consistency as the casino. Cause you can be the house. I'm the house at this shit, bro. I'm the house. I'm the house. They not the house anymore. You gotta come with the same game plan every day until you the house, bro. If you not the house, you gonna keep blowing your accounts. You can keep blowing it. All this shit caught on the dip. Caught on the dip. Player 2025. What's my biggest loser 2025? WRD right now. This is my biggest loser. And it was my fucking it was my biggest winner too, I think. Cause look, I brought it around here 15. My average now is $11. That shit went up there. Biggest loser. But buy the dip, bruh. If you don't buy the dip, you're gonna be sick because you're gonna buy high and then it's gonna fall and you're gonna keep blowing your accounts. Use the higher time frame. The higher time frames you use, the less amount of times you're gonna blow your account. The longer you hold your trade, the less amount of time you're gonna blow your account. The longer you hold the trade, the more money you're gonna make at the same fucking time, bro.